The impact of COVID-19 on IAS 36, asked task 4 by LUKEYUNNIE. IAS 36 breakdown. The main objective of IAS 36 is to ensure that the non-current assets are not carried at an amount that is greater than the asset's recoverable amount. Therefore, when the carrying amount of an asset is greater than the asset's determined recoverable amount, that asset is impaired and written down to its recoverable amount. Assets within the scope of IAS 36 are required to be tested for impairment when indicators exist at year end or any time during the financial year when a specific event may indicate a drop or change in value of assets. Impairment calculation. An impairment loss arises when the carrying amount of the asset is greater than the asset's recoverable amount. Recoverable amount is the greater of the asset's fair value less cost to sell and the asset's value in use. Carrying amount is equal to the asset's cost less accumulated depreciation or amortization and impairment losses. COVID-19 as a triggering event, adverse effects. COVID-19 has interrupted the movement of goods and people throughout the world due to levels of restrictions imposed by government on business and individuals. The resulting impact on financial reporting is significant. The effects of COVID-19 have indicated potential and evident declines in quoted asset values, decreases in profitability and revenue, as well as operational disruptions to supply chains. The cash flows, at least in the near future, of many companies will be affected by COVID-19. Therefore, because of the vulnerability of industries to changes in the market or government restrictions that may halt or limit flow and supply of goods and services, there can be no single specific date on which impairment testing should be carried out. During the year, however, per IAS 36, all relevant assets should be tested for impairment at financial year end, and possibly company policy could be altered or changed to test for impairment regularly throughout the financial year, for example quarterly, due to the unpredictability of COVID-19 on financial reporting of any and/or all industries. COVID-19 as a triggering event, positive effects. While the majority of entities have been adversely affected by the implications of COVID-19, a portion have also benefited, such as those in the medical industry, which have seen major fluctuations in demand, cash flows, profitability, as well as share price. Due to the drastic demand for alcohol sanitizers, ventilation machines, and the race to develop, produce, and distribute vaccines, to name a few. In this case, the impact of the pandemic may potentially lead to impairment loss reversals on non-current assets that prior to COVID-19 had become impaired. Major variables to consider when calculating impairment of assets due to COVID-19. Determination of an entity's recoverable amount. A multi-scenario analysis of the impacts should be carried out, taking into consideration the key drivers of revenue and its various components, as well as any potential forecasting of government stimulus if the company qualifies. Probabilities are to be assigned to each scenario and the scenario with the highest probability implemented. Value and use. An entity needs to determine the effects, favorable or adverse, on its expected future cash flows to be derived from the asset or cash generating unit, based on the impact of COVID-19 has had on them, so that the most accurate present value of said cash flows can be determined. The appropriate pre-tax discount rate would also need to be used on the entity's capital structure, based on the entity's capital structure, as well as the time value of money and the type of risk that asset in question is exposed to due to COVID-19. Fair value less cost to sell, based on the most probable scenario determined, along with IFRS 13 principles, the fair value of the price that would be received to sell the asset in an ordinary transaction between market participants at the measurement date, less the cost to sell that asset. In the event that the reporting entity is in a favorable position, an impairment reversal may arise, as the recoverable amount of an asset/assets may have increased since the impairment loss was recognized, limited to the historical carrying amount of the asset at the date of the reversal. Conclusion. The impacts of COVID-19 are not necessarily industry or entity specific. Makes it challenging to prepare reasonable and supportable projections due to the levels of uncertainty. Heavy reliance will be placed on an entity's accuracy in their multi-scenario analysis when calculating recoverable amounts for impairment in an environment that is vulnerable and exposed to change. References. Thank you very much for listening to my presentation on IAS 36. Have a good day.